welcome back to the channel, guys. I just wanted to talk about the impact of withholding tax and expenses on funds. I've called out my view on this and my opinion around it and why I'm really about not paying extra fees or really keeping your withholding tax down. And I really want to talk about the numbers and really break it out so you can visually see and understand this, because it is a silent impact on your compounding. And here, if we look at just an example of where you could be sacrificing almost over 400K. Now, that isn't your investment amount, that's how much you've sacrificed. And if you were to have a 100K investment over 30 years and the fund was at a 1% fee and a 30% withholding tax, we can actually see how that impacts your numbers. And if we look at this directly, if we were to break it out in terms of the drag on the fund, so the fees, you're getting 307K, that's not a typo, 307K of compounding impact on the 1% fee alone. Okay. If we then add the withholding tax, that's another 176K of drag on your overall portfolio. So combined, you've sacrificed that 401K. 64% of that's coming from the fees and 36% is coming from the withholding tax. That's big numbers, right? Okay, it's over a decent time period, but we can see that compounding not only can work in your favor, but when it comes to fees and withholding tax, it can compound against you. And this is why when you are looking at those high yield returns, you need to, yes, of course, look at the high returns. You need to also focus on the expense ratios, but also look at optimizing the domicile of the funds and the net returns of the funds as well, which obviously impacts your total returns as well. So I'm going to dive into the different domiciles in a second, but I think the real takeaway that I want people to realize here is how badly fees and withholding taxes can impact your portfolio. Okay. And it's not only the taxes that happen within the fund, it's also the taxes that happen at a personal level as well. I won't touch too much on personal tax because this isn't a personal tax type video and I'm not a tax advisor. But again, that's just something else. The reason why I like to put my investments in an ISA wrapper or a SIP wrapper for that reason. So if we start to look at the drag from the withholding tax, and I like to call it withholding tax trap in a way, when you invest internationally, foreign governments often withhold tax. Okay, that's why we call it withholding tax. And they typically do this on your dividends at a high statutory rate. But there are treaties that kind of allow lower rates, reclaiming the difference, but it can vary depending on the type of fund it is and where it's located, i.e. where it's domiciled. Okay. For United States, the tax rate for most places is 30%. But they have a treaty with certain regions where that drops to 50%. And that's why you always hear these, oh, it's a 15% withholding tax. If you were to do it at a personal level, you need to make sure that your broker, you filled out a W8BN form with your broker to be applicable for dividends and get the 15%. It's slightly different for funds, and it's slightly different if you hold the underlying directly. If you hold the underlying directly, and it pays a dividend, then you need to make sure you fill out that W8BN form. If it's for a fund, it gets done at source within the fund, and then you get paid out net of that withholding tax. Okay. So the drag number 2 is the fees. So every fund will have what they call total expense ratio, or TER, and it's normally put within their KID or put on their website. Okay. And you've got to keep your costs balanced when you start to do these investments. So there are two elements to the fees. There's the ones that sit within the fund, which is the TER, which is the management fees that pays the portfolio managers, the running, legal, accounting, custody fees, those kind of admin fees, and then obviously the marketing fees that pay for the advertising and the distributions, etc. But then even that sits without the fund, there's your broker's fees, so the fee you pay to buy and sell. Now, some brokers have no fees, like Trading 212 in the UK. Some brokers have fees, like HL. Sometimes there is just a one-time fee on purchase or sale, And then you've got the account fees. So there's normally some kind of platform fee to maintain. Some of them don't have that. Again, Trading 212 doesn't have any, but again, platforms like HL do have these management fees. So again, these also impact your total returns. Okay. So when we talk about withholding tax, it's either that 30%, 15%. And then when we talk about the other element of fees, it's the fund fees as well as your broker fees. Okay. If we then start to look at the withholding tax at source element, because I'm talking about funds now rather than the direct owning of a stock, there are three different avenues. Okay. There is path number one, which is quite inefficient, where you've invested in a US company that pays you $100 dividends. The US government holds 30% of that, so $30. And then if your fund is in, let's say, Luxembourg or Jersey, where there is no kind of treaty in place, the fund receives $70 and then they issue out that $70. Obviously, that's not the best scenario. Scenario number two is slightly more efficient, where the US company pays a $100 dividend. The government withholds 15% or $15. Let's say it's Ireland domiciled and there is a withholding tax treaty there. The fund gets $85 and $85 is reinvested. Okay, so you've benefited the $15 and the 15%. There is one final path, which is what we're seeing with funds like income shares, where at source they're getting $100. Because it's a treaty where it's interest and not dividends, and options premiums are treated as interest, there is actually zero withholding tax, $0. So the Irish fund really receives $100 and income shares are able to give out those $100. So you can see how you can go from $30 to $0 depending on the type of path it takes. Obviously, this is at the fund level, not the personal tax level. Okay, so if you are holding this outside of a junior ISA, an ISA, a SIP, etc., you still need to bear in mind the personal tax. And this is where it can be a bit of a conundrum, because obviously if you're holding it in a general investment account, then the income that comes as interest is taxed as your income and is your income tax rates, whereas the dividends that come in at your dividend tax rate from a personal tax perspective. So it's always important to speak to a tax advisor on what makes sense for you. So taking the hit, for example, in path number two may be worthwhile if it's outside of a tax wrapper, whereas path three might make more sense if it's within a tax wrapper. Obviously, path one doesn't really work well with any scenario, whether it's inside or outside of a tax wrapper, which is why I'm quite against a fund that's not getting that tax benefit, because you're just giving away growth. You've seen at the start where I mentioned the amount of sacrifice that you could be making, and it could be 36% over a period of time. That's huge, and that just gets worse and worse the longer the time takes and the compounding takes over. So there's almost this negative compounding effect. So the thing to also think about is not all income is taxed alike. Okay, the options advantage there around the tax treatment, as I said, dividends is 15% withholding tax if it was held within an Irish fund. Interest and options premium is 0%. So we can see why part of the reason why they're doing this distribution as interest is because of some of that tax treatment. So a lot of people questioned, why they're not doing it as dividends. It makes it worse for us at a personal level, but this is one of the reasons why. And obviously we've got the advantage of holding these within a tax wrapper. So that is an advantage at a personal level. So again, it's thinking about all the different options that fit your particular user case in your particular scenario. Okay, if we look at the domiciling piece. Now, domicile just means location of where the fund has been set up. So for non-US investors, fund domicile is quite critical, okay? But obviously the type of income also matters. So the tax treatment advantage of domiciling, like in Ireland, is more pronounced for dividend income, while interest income is often across many jurisdictions because the treaty works across many locations. But this is why we see so many funds that are domiciled in Ireland for that particular tax treatment reason. And we can see like the tax treatment and withholding on US dividends doesn't work well for certain locations like Luxembourg, Jersey, but we get that 15% on US dividends within Ireland. We can also see withholding tax on US interest actually works really well across the board, except for certain locations where there is no treaty in place. And you can see Jersey as an example of where it lacks that treaty. So obviously try and pick funds according to where there is quite a lot of tax advantage. And normally these fund managers are obviously trying to target the locations which ultimately benefit them from a tax treatment perspective, because it not only benefits the fund, but it also benefits the investor that's investing in that fund, and they know people are going to eventually catch on, and they're going to buy funds within that tax advantage. So I just want to visualize this and summarize this, that over a 30-year period, I just want to show you that if you were to have this inefficient fund where it's 1% fee, 30% withholding tax, that 100K turns into just 650K, which is still amazing returns, right? But a more efficient fund at 0.25% fees, 15 withholding tax, is 853K. If there was no fees, it'd be over $1 million. Okay, but the reality is that's quite hard to achieve. But we can see how these lines are getting separated out further and further apart as time goes on, as that compounding takes over. So this is what I mean by the fact that compounding is your friend, but when it comes to withholding tax and fees, it's not your friend. It's almost your enemy. It's almost impacting and slowing you down, slowing that momentum down. So the gaps between the lines get worse and worse over time. Okay, so thinking about this from an investor's perspective and almost a checklist. So how to maximize your return. So the key thing here is obviously prioritizing your domicile, looking at the fees, verifying the fund's domicile. Is it the most tax efficient choice for the assets you want to own, e.g. Ireland for US stocks? What is its asset location? Are you planning to put it in a pension? Are you planning to put it in ISA? Is it going to sit in a general account? Okay. Thinking about the total expense ratio, not just the market average, but the lowest cost alternatives, particularly if it's a passive fund, right? But you still got to care about net returns, right? So focus on the costs after tax, the return, making sure that you're prioritizing your disposable income. So again, the net returns or total net returns is still really important, but I just want you to make sure that when you look at this, you account for the fees element and the expense ratios within those numbers as well, okay? Because they can impact. This is becoming more and more important as we're seeing more and more funds coming out that are very similar, and people are like, oh, shall I pick this one? Shall I pick that one? And it's becoming quite hard because they own very similar underlyings, they own very similar strategies. So then it comes down for me in my head around, can I get them in an ISA? Can I get them in a SIP? Can I get them in a domicile region where it's more tax efficient? All of those kinds of things make such a big impact. And this graph shows that and demonstrates how important that is over a longer period of time. So don't let compounding costs win, okay? Over your investment lifetime, the difference between an efficient and an inefficient investment can be staggering, okay? So by prioritizing low-cost, tax-optimized vehicles, you can ensure that the miracle of compounding returns works for you and not against you. So hopefully, guys, this was a good overview of kind of the impact on fees, etc. Write in the comments your thoughts around this and let me know which camp you lie in, whether actually happy to pay the extra fees because you believe in the fund provider, or because you're just happy that actually your net returns are still good enough and you're not as bothered by fees. But let me know your thoughts in the comments, guys. Hopefully this was a good one and an entertaining one and a useful one. Okay, guys, I'll catch you on the next one.